Stop hunting. Does it exist? Yes. Stop hunting does exist. But no, it's not for the reason that you might think. Because most retail traders have this idea of an evil institutional trader wanting to take their money. Doesn't work that way. So let's have a look at things from the perspective of the institutional trader. When you're trading with size, it's actually not that easy to get a fill of your entire position in one go. So institutional traders will frequently have to create liquidity first by doing a whole bunch of smaller trades in order to reach the level of liquidity where they can see that there are enough units available for them to initiate their positions. And these levels are actually known as supply-demand levels. This is in the first module that I teach you in the Market Stalkers method. Another point to make is that institutional traders are pretty much immediately taught to buy and sell at really good levels. Levels that offer an intrinsic, naturally low risk and high reward. And those are usually located at the top and bottom of the observable swings. Whereas retail traders will be sat there waiting for endless confirmations until the market moves quite a bit away from their level. So why do they do this? It's due to lack of confidence, but also mainly due to lack of knowledge about probabilities attached to what can actually happen at a particular level of interest. Now, the thing to take away from all of this is that when the institutional trader tries to generate liquidity in order to reach their areas of interest, those deep liquidity pools, they will be using a bunch of little orders to make the market sort of move up or down. And even once the price gets to their level, they will still need multiple fills, multiple orders. And sometimes, because of all of this, you will see some less relevant highs and lows being taken out before the market actually turns around. Because institutional traders have to look at any area not as just like one key price, but kind of as a zone. You as a retail trader, when you enter one contract, it gets filled immediately, right? And the same with your stop losses and your targets. But with the institutional traders, things are really not that easy. So it's not that the institutional trader is going, I wonder what Dave's stop loss is. No, it's just that Dave has placed his entry quite a bit away from the relevant level, and then usually placed his stop loss just above or below it. Because retail traders never really think about any level as a zone, or most don't. There are some that do, obviously, like supply and demand traders and etc. But most people, when they first get into trading, that's not their first go-to, right? And they think that by doing something like this is a good choice for a stop loss placement. Now this, my lovely market stalkers, is a prime example of not just a bad stop loss placement, but also a bad trade location. So what would be a good trade location? Well, first you would need to identify where the top and bottom of the swings are. Maybe look at some distribution curves, look at your average ranges, and then stay away from the middle of the ranges until you're very familiar with the auction process setups and you understand when the trade is a momentum trade and you can be forgiven for entering in a slightly less of a perfect area, which of course you would know because you've taken my Market Stalkers method program. So you know how to look for a successful or an unsuccessful auction. Link to the method is actually down in the description box, so check that out. Until then, don't diddle in the middle. Aim to get involved at the extremes of observable intraday ranges, because the reward on the trade will always be a lot higher just naturally, and also you will be way ahead of some of the other moppets that are constantly buying tops and selling bottoms. And whatever the level is, whether it's the edge of a distribution curve or ATR or a second standard deviation, and then couple all of that with the time of day that I teach you in the method. Because in order to start improving your trading results, you really need to focus on good trading locations. One of the worst things I've heard from traders getting involved at like crappy trading locations is something along the lines of, yeah, you know, this is a very risky one, I just tightened the stop. No! And then they usually go, oh, well, this one is no good, let me look at something else. And then they go and find another crappy trading location and open an equally bad trade there too. That's not the solution. Your stop losses need to have a good placement. Now, if you messed up entering the trade for whatever reason, you then cannot justify using a terrible stop loss as well. So your stop loss will still need to be away from the line in the sand level that you're referencing, and also away from any round numbers too, and away from the middle of the middle, which also goes for your trade entry, by the way. Prime example of middle of the middle would be anything relating to a moving average, middle of swings, POC as well from market profile. That's the middle of the middle. That is the widest point of the profile. I have a whole video explaining that. I might put it somewhere up here. Bottom line is, let's stop blaming institutional traders for your own bad trading and start working on improving your knowledge, your entries, and your stop loss placements. Now, if you have some other issues, like for example, if you keep opening multiple active positions and you keep kind of losing the plot, getting frustrated, you might want to have a look at this video, because I actually had a female trader who was doing just that. And in this video, I explain how we managed to rein in her wild side. Now, until then, let's try to be less of a muppet and more of a market stalker with every passing day.